plus years.
Yeah, we've been there a couple times. Just the touristy stuff, doing the strip, doing the sites. But man, we did it pre-kids, so it is. I'm sure it's an extremely different scene without kids.
Yeah, it is. Yeah.
And what's it like, this year with, because bars and live music, that's when I think of Nashville, that's what I think. What's it like?
Yeah, it's been a real challenge. We don't have a state income tax, so we really rely on sales tax to support our budget. And it's been very challenging. We don't have strong leadership on the state level, so it's been, local, city level directives, and it's been very schizophrenic. Between what you can do in Nashville versus what you can do in Memphis versus what you can do in Knoxville, et cetera, and outer counties especially. It's been a real challenge. They had to increase property taxes 32%.
What?
To cover, yeah.
In Nashville,
in
that
Davidson,
area?
Yeah.
Wow.
Yeah. Very painful.
That's just for budget shortfalls on the local level.
Mm-hmm.
Wow. And that's amazing. I didn't know it was that nuanced. I thought, so the governor is not behaving like, so currently I'm in Oregon,
mm-hmm.
and our governor is kind of like California's little cousin. And it's very frustrating because I think it's overreaching and it's arbitrary. A lot of the directives, like we couldn't have more than 6 people in our house for Thanksgiving. Otherwise you'd be potentially getting a misdemeanor and a $1,200 fine. And yet we can smoke crack. So that's good. Because all drugs are legal here.
Yeah. It's, our governor is very much a Trump disciple.
Got it.
So has not really made any comments. There's no statewide mask mandate. Bars and restaurants are open, but public schools are closed, which does not follow the, health professionals' advice. This is very challenging. And, I hope he can roll out the vaccines in an orderly fashion, but I have serious doubts. I think Tennessee is going to be dysfunctional when it comes to that, to be honest.
Well, I think the whole nation is. That one of my thing, whether you like Trump or not, it was a breakdown in directive leadership. Like it just like deciding what to do and saying, here's where we stand as a country, and leading from that position, not necessarily telling people what to do, but just taking it seriously and setting a good example. Holy cow, that would have been a game changer for the whole country. And I don't think the vaccine is going to be rolled out until Biden gets into office. Honestly, I mean, it'd be rolled out a little bit. I know in Cincinnati, they did some of the trials at UC Health, so they already have some there. But yeah, I'm not holding my breath, nor am I going to be the one to take it right away. I'm going to wait. I've got a lot of family members that are in the healthcare industry, and they're just like, it's like buying the first year of a car. You let that first year go and let them fix all the kinks and figure out more and learn more about it. And then by the second year, they usually will have it figured out. So yeah, I'm not excited about jumping right into that thing, but man, I did not know it was that bad. How are the bars and restaurants doing downtown? They're doing fine.
No, I assume they're all struggling. I think they're all doing really poorly.
Yeah, we went to Florida for a month to escape the fires out here that we had in September. And it was so odd, the juxtaposition of like Florida, they have like mandates to be open.
Yeah.
Here it's mandates to be closed, and just the difference in culture and the way people think about this disease is pretty impressive to see. And it'll be really interesting to me to kind of see how it plays out and how it will be different between the states that kind of are like, Tennessee, or like what I call the red states, versus the blue states, where everyone's so terrified of it here. for good reason. Yeah, it'll be really interesting to see economically. And when you reached out, so kind of to dovetail this a little bit into, you reached out. I loved the subject of your email, the future of commercial real estate. It piqued my interest because I've had a lot of conversations with various people in the industry, outside the industry, a lot of Fortune 500 companies, talk to them about that topic, and none of it's good. And I don't know if it's just where we're at with like peak fear. We're making all these drastic changes, but I really wanted to get your perspective on the commercial real estate industry, and then just investing in real estate in general is a good place
happy
to start. So
happy to do it.
Yeah. So yeah, like, what are you thinking? And we can nuance this down into different sectors, because I'm sure, in different areas, I'm sure it'll all be handled and treated differently. But yeah, so just kind of give me your take on the commercial real estate market.
Yeah. Are we live?
Oh, yeah, we're live. We started right from the beginning. I just go, I'm not formal. We just talk, and yeah, I'll chop off the first couple minutes.
Sure.
But yeah, I just like to start and go.
Yeah. So commercial real estate, it's a spectrum like anything else, right? And I think the way that investors, individuals and families, what I call taxable investors, so as opposed to institutional investors, which don't have to worry about taxes, I think you need to look at investing in commercial real estate as on a risk adjusted basis. And so today, if you wanted to, you could invest in Class A distribution warehouse that Amazon is the single tenant.
Right.
And, you could do those deals. You're probably going to get a 2 to 3% return on your money, maybe. And that's gross. Yeah. Because they're very safe. It's very institutionalized, and there's no risk associated with it, right? There's no risk premium where you're getting a return for your money.
Because Amazon is not going anywhere, and they're signing.
Amazon's not going anywhere. It's the sexy play right now. Everyone believes in last mile fulfillment, distribution, industrial, and the work from home movement is very much in everyone's mind. So you could do things like that. You could invest in self-storage, data centers, cold storage, Class A distribution warehouses, etc. But your return profile is going to be really bad. You could go on the other end of the spectrum, and you could look at hotels and retail, where very risky, but huge potential rewards there and returns. My advice to people is you probably want to be somewhere in the middle. So you look at multifamily, you look at office and some other associated asset classes where you can still get somewhere north of a 6% cash on cash yield.
Even an office?
Yeah. So our portfolio, we run about 2.5 million square feet. It's about 375 million gross. We're clipping off on average around 10 to 11% cash on cash yields.
So and you're talking specifically in office.
Suburban office.
Okay. So that has really been, I mean, the conversation around hotels seems to be a little bit obvious. I think we saw peak business travel in February. I'm not sure we'll ever see that until population numbers catch up, but as a percentage of people who work and hop on a plane to go to a meeting, I don't think we're going to see that. And if we do, it's going to be a long time before we see that. And the more we adopt this type of communication, the more people are realizing we just I don't need to spend 2 days traveling for an hour meeting, internal meeting. It doesn't make any sense. And so, yeah, hotels are going to be a huge hit in terms of that, because I don't know what percentage of hotel revenue comes from business travel, but my guess is it's probably pretty significant. So that makes sense. But like the office is where I have a wide array of conversations, because and I don't know, I've kind of equated it to the way a pendulum swings. Like we were on one end of the pendulum before COVID, and then COVID hit, and we swung to a complete opposite side where everyone's home. and it's going to settle somewhere in the middle. It's not going to settle back where it was. Again, until population numbers just increase to supply that. But what that means is that with the number of square feet that we have in office space, I'm really talking about downtown offices. It seems like I just hear story after story of big companies renegotiating their leases for smaller spaces or just walking away from them. So how does this impact commercial real estate?
Yeah. So when you're thinking about potentially investing in commercial real estate, I think it's really important to have an investment thesis, to have an idea in your head that you believe in, that you can find tangible to yourself and you have some kind of experience in. And that's why office and multifamily are very attractive to individuals, because we all have some type of experience associated with those two asset classes.
Mm-hmm.
We either lived in an apartment, or we certainly visited people that lived in apartments, and we have at some point in our lives worked in an office building. So the way that we think about the world is demographics are destiny. And no matter what part of the commercial real estate spectrum you're investing in, it's going to improve when there are positive population increases, positive job growth, and positive wage growth. And so the markets that we identified are secondary markets in the Southeast and the Midwest that have all of those features.
Mm.
And there's been a narrative in Wall Street where, you know, this maturing millennial generation, which I'm barely a part of, but I do kind of qualify, was never going to live in the suburbs, that they were going to stay in Brooklyn, wear skinny jeans, eat avocado toast, never get married, never have kids. And that was going to be what they did forever. Clearly not the case. Because of 2008, that phase of life where they're going through family formation got pushed back on average 3 to 5 years, but it is now occurring. And what you've seen is dovetailing with the pandemic, accelerating these trends that were already existing, where these families of kind of mid to late 30-year-olds were starting to choose where they wanted to live, work, and play based on quality of life, cost of living, access to single family homes, and access to education for their children. All of us always rebel against our parents' generation and say that we will never live that style of life. The reality is most of us end up doing just that. My parents were flower children of the 60s. They rebelled against their baby boomer parents, but they ended up living in the suburbs, really caring about where their kids went to school and working white collar jobs for the most part. And so we're seeing the same thing play out with millennials. And when you look at the data, the U-Haul numbers just came out recently. I posted them on LinkedIn, and it's pretty straightforward. Expensive, liberal, political cities in the coasts and Chicago, for the most part, are losing population, and they're moving to interior Midwest cities and Southeast cities, and especially Texas and Florida. And so when you think about investing, I think it's important to have some kind of perspective there. And so that's kind of the backbone of how we think about where to look. When we think about office and your question about work from home, it's a really good one. Pre-pandemic, 4% of the workforce worked remotely, which is different than working from home. I think it's important to draw that distinction. Meanwhile, the average square foot per user in an office building was going down dramatically since 2008, which we call the WeWork effect, where you were trying to cram as many people as possible into a small area, hoteling, hot desking, whatever term you want to use it. Traditional office layout is around 350 square foot per employee. Some WeWork locations are down to 75 square feet per user.
Whoa.
Now, clearly, we're going to increase the amount of people working remotely, but we're going to decrease that density shift. I think the pendulum is going to swing the other way. Regardless of where we are in the vaccine, more people are going to want a true office with a door where they can think and do work. Meanwhile, we're also going to want that collaborative team experience where we do go to the office. And so I think a world where most people are in the office 3 days a week, where they're performing some kind of creative, collaborative efforts and maybe getting really focused work done if they don't have a home office. I think all those things is frankly going to be pretty close to a wash.
Think so?
Yeah, because if you just think about, 3 days a week, but you're 3xing the amount of space per user, it's going to be pretty even.
But doesn't that make rent like the cost of offices rise? Like, because
Yeah.
like if you just look at a person, like if you boil it down to like employee is at the WeWork, you said 75 square foot a person, and so then you can extrapolate out, what do you pay that? What does that person cost to take up to occupy that space? Now that space is increasing. So it seems like the amount of time, the amount of cost it goes up, right? And so, but
Right. So
so like I think, wouldn't you have a dynamic where companies, you're the first person I've heard that isn't pessimistic. A wash in today's term to me is optimistic, right? Um, and so the I'm just curious. I'd like to talk more about that, because it doesn't intuitively sound right. Because so you said 4% were work remotely.
Mhm.
What's the number estimated on whatever the other end of this is like? Isn't it like 18 or 20%?
Yeah, I mean, listen, we all suffer from recency bias. We all think the way we spent the last 6 months is how we're going to be spending the next 6 years.
Uh,
And people have called for the death of office about every 10 years. Telecommuting occurred in the 70s with IBM and Bell Labs, and it was a failure. The 80s with the market crash, same thing happened in New York. You've got 9/11, you have 2008, and every time offices proved to be a very resilient asset class. Today the November numbers just came out for Kroll for CMBS.
what is that?
Uh, it's a rating agency that rates CMBS bonds, and so you look at the delinquency rate. Hotels are about 25%, offices less than 1%. So for the most part, people are paying rent.
Well, that's
And
because
they're
they have to, right? Like, so
right.
wouldn't leases aren't up yet. Like, we're still new into this pandemic.
Right. So my point is extrapolating what's going to happen in an asset class where the weighted average lease term, which is kind of how we gauge how much stability is in a building, is sometimes 5 or 7 or 10 years.
Mm-hmm.
I think is wasting a lot of time conjecturing, because nobody really knows
Right.
until these leases renew or they roll. But to answer your question, roughly 10% of operating expenses for businesses goes towards leasing.
Okay.
Now, this is clearly a good time to reset some of that pricing and maybe take some of that off the table. That means that you're going to look at that fixed cost much differently today. And that's where suburban office and secondary markets is a more affordable option
Mm,
with more flexibility in the layouts of the spaces and can handle more volume of people, because you have to remember, even though density may change, these markets that are experiencing these big demographic shifts, they don't have public transportation like the big coastal markets do. So you still have to park the bodies. And suburban office typically has somewhere in a 3 to maybe even a 5 parking spot per 1,000 square foot ratio. So it can handle that kind of density of people. And that's where, I think suburban office is really well positioned, frankly.
yeah, I agree with that. Absolutely. Yeah, it's tough because the term office investing, most people think downtown. And I would you agree that downtowns, like city centers, are going to suffer in terms of their valuations and the amount of usage people get, whether it's living or working or playing downtown over the next 10 years, where suburban office centers, I mean, I see it. I used to live in Cincinnati, and you just see all these hubs where you have Kenwood, you have the
We
Rookwood.
we own in Blue Ash, so I'm
Okay.
familiar with the market. Yeah.
Yeah, so like all up in there, you just see these basically high rises, whether they're 10 or 15-story buildings right off the freeway, and you have these little tiny, what I call city centers, that have popped up. This
Yeah.
was pre-COVID. So what you're saying is those are going to continue to thrive.
Yeah.
Uh,
If you think about how people live their lives, for the most part, it's a 15-minute circumference to where they live, where their kids go to
work.
school. where their club is, where they work, where their social life is. And so what I think you'll see are these, maturing suburban areas become little hubs, and employers will shift towards a hub and spoke model where the mothership might still be in Seattle or Portland or LA or New York, but the employers are smart, right? And they want to plant a flag to where that human capital is moving and going to be living. And that's why you're seeing Amazon and Facebook and Microsoft just gobbling up huge amount of square footage, both on purchase and lease, because they understand that the office is going to be a big part of how they can maintain that edge in the marketplace. And they're seeing this as a buying opportunity.
Right.
For individual investors, frankly, it's really hard to get exposure to downtown office buildings unless you're going to invest through a REIT. And when you look at the office REIT market, it was down roughly 40% at the nadir of the pandemic. It's come back quite dramatically, but it's still down probably 10% pre-pandemic. So I think the street is giving you a pretty good sense of where they think office is going to shake out. And they're looking at about a 10% discount right now. That's for that's for CBD downtown office towers.
Do you think that accurately factors in the government assistance?
What do you mean?
Well, it's a timeline issue in my mind. You've got this pressure so whether it's unemployment or the paycheck protection loans, the bond buying, to deliver or liquidity to the market, you've got all of that happening based on assumptions of a timeline that we're going to get past this, right? Then you also at the same time have a timeline of leases coming up, right? And so you have artificial demand in terms of liquidity in the place where people can afford to pay longer, whatever. I'm talking a macro picture. But you also have this, it seems like there's this event that might happen in the future where people stop, like we said before, people might actually stop renewing their leases. They might decide they're just not comfortable going back to the office, and that those percentages we're estimating are lower than reality. So anyway, when it comes to REITs and they're only, let's call it a 10% discount, how much of that is, much like the stock market, is based on the fact that the government is basically helping everybody at this point?
Yeah, sure. So one thing to make clear is the REIT market is a pretty poor proxy for direct real estate investing. It behaves like the stock market. The correlations to the S&P and other indices are extremely high and tight. So it doesn't behave like true private commercial real estate investing. That being said, PPP loans theoretically were only meant to go towards staff. And CMBS bond markets were not included in TALF 2.0, which is kind of the bond purchasing program you're talking about. So there's not been a lot of artificial aid to the commercial real estate market, unfortunately. I wish the CMBS was included in TALF 2.0. I think it would have made a big difference to a lot of hotel owners who have to give the keys back because they can't hold on. But for whatever reason, Congress didn't include it. So, when you think about that 10% discount, and that's where, going back to our first conversation initially, it's all about that risk adjusted return, right? So if your REIT portfolio is giving you, call it a 7% yield or a 6% yield, that's probably worth it in today's market. And that's where private real estate that can still give you something in that 8 to maybe even double digit yield, there's risk associated with that. You can't get that kind of return without taking on some kind of illiquidity and risk premium. But in today's kind of zero rate environment, and with the market just ripping, I think it's still a pretty good risk adjusted return.
Right. Well, and that I agree with you. I just wonder, at what point, when the music stops in terms of government, or it may never stop, but as long as interest rates stay zero.
Yeah. I think the real question, this is the real question, right? Does debt even matter any longer on a federal national level?
Which is
will it ever matter again? I mean, It doesn't seem to be affecting the dollar. It doesn't seem to be affecting our credit rating. Our bond sales are overbought every issuance. Nobody seems to care about what our debt to GDP is. And I think the Fed's understanding of how they want to play this out is we'll keep rates low and we'll inflate our way out of our debt over time. But with Yellen coming in, I don't see that changing at any point in the next 4 years. So
Sure.
to me, the debt seems to be irrelevant, and we're just going to keep pushing it higher.
Yeah. So as one of my points of study was macroeconomics, and what you just said makes no sense, like no logical sense. Debt always matters. It doesn't matter until it does. And I think the game that's being played is a relative game. When everyone does the same thing, it may not matter. And it may not matter for a much longer period of time than if, let's say, the European Union or China decides to go a different direction. And then everyone is printing and they stop and are able to maintain growth. That, to me, is the point at which it does matter, because rates will go up. The value of our currency will decline. We'll have a time where you can inflate your way out as long as interest rates are low, which also doesn't make any sense. And so the risk that we're taking is that rates will stay low. And I'm not convinced. It may not happen for 10 or 20 years, but I'm not convinced that that is something that the words forever could ever be uttered, because economics is a principle that's much like math. It's rooted in very basic fundamentals that, like math and physics, it's once one those principles, 2 + 2 = 4. You can only there's only so much income to pay so much debt. And once that gets out of whack, unless you invent something else, it has to, the piper has to be paid at some point, right?
Yeah, I don't disagree that there may be a reckoning at some point 20, 50 years down the road, but it seems very clear that politicians have realized that they no longer want the US economy to go through natural cyclical events like recessions. They want to use the Fed and put the Fed in their pocket to make sure that any recessions that do occur are very short, and we, kind of rebound dramatically, because they don't want to affect the election cycle.
Right.
And so until the Fed is given greater independence, or there is some kind of larger conversation about this eventful reckoning, I think every politician who's working on a 2-year election cycle, nobody wants to mess with it. So I don't think it's going to change anytime soon.
Yeah, I agree. It was 2008 where it all started, and we're 12 years into this experiment. I logic would suggest that it doesn't end well. But yeah, I think you're right. I think the longer it goes, the bigger that reckoning will be. The bigger, if we all of a sudden in 20, 30 years have $100 trillion in debt, I mean, it's really hard to imagine a day when interest rates move 0.25% with that haul. It'll wipe out the cost of Medicare just in terms of that. So that's what, that's a different conversation for a different time. This whole modern economic theory is
right.
To me.
Yeah, it's fascinating. And the lesson we've all learned from 2008 is the risk takers and the asset managers who benefit from this, there's no real repercussions. So they're going to continue to take risk and continue to use their balance sheets to,
well, we're seeing it play out today. The S&P the PE ratio on the S&P is 37. We're like 3 points shy of the .com bubble.
Mm-hmm.
And everyone's like, oh, stocks are cheap right now. I don't understand how that's possible, except you have an artificial inflation of PE ratios. You cannot find yield in bonds.
Correct.
And so it's forcing everyone to take risk, and that doesn't end well ever.
Yeah, I would agree. And they're telling two different stories, right? The market is saying that there's good news on the horizon. There's a lot of growth to be had, that things are going to be exciting for, forward looking. But in my limited experience and based on the Wall Street guys that I know, typically the bond guys are a lot smarter and they know, and bonds are signaling stagnation, lack of growth, fear.
Well, I think the bond market signals is rooted in organics. Their formulas are based on organic growth. A company produces $1, it spends 50 cents producing that dollar, it has 50 cents profit. Now we can value bonds based on that. Today, it's a company produces $1, it gets free money from the government at 50 cents to cover all its costs, and now its profit is $1. That doesn't make any sense to the bond market because you cannot extrapolate the risk of when, how much, and if the government's going to inject that. So yeah, I think we're in this weird time where it feels like the dot-com bubble, but the bubble's everywhere. It feels like the Roaring '20s. It feels like the what was the tulip craze of the Dutch tulip craze?
Yeah,
It feels like
16th
that,
century or
but
something.
it's everywhere. Like there
Yeah.
isn't an asset class that isn't overvalued, which is really weird to me.
And yeah, and I completely agree. It's so weird how all these things that typically are a hedge or diversification are all behaving in the same manner, and they're all correlated and going up to the right. And to your question earlier, the question I've gotten for my investors is, hey, where are the deals in real estate? And I'll be honest with you, we're pretty active right now. Cap rates have gone down since the pandemic, which for
Can
the
you explain
listeners
to
is,
the listener
yeah,
what a cap rate is?
cap rate is the equivalent of like EBITDA, where you can use how much you pay for something versus how much income that asset produces as a ratio, so that you can do an apples to apples comparison to if you're buying an office building in New York City or you're buying an office building in Des Moines. You can still use cap rate, but they're going to be widely differential. And so when cap rates go down, it means that people are paying more for that income.
Right.
Um,
So it's like
so
the inverse of a PE ratio.
correct. Yeah.
Right.
So for instance, most suburban cap rate would be in that 7 to 8% range. So if you were to buy it unlevered, you'd be producing a 7% kind of yield on your money. And the crazy thing is, like, a well-located building, even if it is office and, there's questions about the future of office, it's more expensive to buy it today than it was pre-pandemic. And so what you're seeing is what we're talking about, right? Is if you create all this free money, if you inject all this capital into the system, it will go somewhere. Right? And it's going to the stock market because there's nowhere else to go. It's going to bonds because there's nowhere else to go. It's going to real estate because there's nowhere else to go. And so, it's like this tsunami of capital that's impacting everything.
Do you think that the reason we have not adopted a universal basic income or just given more money to people like in other countries is because that will cause rates to rise?
Because that will cause rates to rise.
I mean,
It's really
essentially, if you just give money to people in America, they'll spend it, right? And so you'll have inflation happen. So like the big thing now is one of the reasons we haven't seen inflation over the last 20 years is because wages have basically been stagnant.
Yeah.
Which is how you've created this wealth divide. And I see that continuing now that's unfortunate. Like I'm a cynic. And so I have zero faith and trust in our government leaders. And I can imagine that they had a meeting and talked about that of we cannot give money to people because they will spend it. It will cause inflation and we have all this debt and we're fucked.
Yeah.
I think they had a conversation of let's give it to businesses and hope they give it to some people. But as long as businesses thrive, then people will have jobs. They won't earn any extra money, but they'll have jobs. To me, it's dark. But
yeah, that's a really interesting way to look at it. And even more so because the Fed has been trying to achieve inflation and failed to do so for a long time now.
I think that's a story they've told that just to tell the story. I don't think they've tried to achieve it at all.
Yeah. I mean, I think this dual mandate of employment and inflation is no longer viable to achieve together. And they've decided we're just going to get max employment, keep everyone happy, to avoid civil unrest, social unrest. And that's the direction we're going to head in, because that's ultimately what gets politicians reelected, is when the economy the market in this case is good, right? So I don't disagree with you. I think, to be a real cynic, part of that conversation I think definitely did happen. And nobody in the Trump administration wanted to be painted with a brush that they were socialists, because that really has true echoes of, legitimate socialist ideals. Not to say that they should be discounted, but I don't think they wanted to be associated with that type of approach. And I do think universal basic income is coming in some form or fashion.
Yeah. Help me. So in the debt market, well, actually, I was going to if you could, do you know much about, well, I'm concerned about canceling student debt.
Mm-hmm.
And while I don't necessarily want to dwell on that topic, to me, it screams of, well, today it's student debt. And then what is it tomorrow? What type of debt will the politicians want to cancel to get votes? Because I see that. I mean, it's a solution to a problem, but it's not the solution to the problem of the cost of education. At what point is it, like, let's say they want to help out the auto industry. That's a pretty easy way to help them out. Let's just cancel some car loans. Like, you can nuance it down really quickly. I think it's a very slippery slope, because it also, the unintended consequences of doing something like that is, what about all the people that worked their ass off to pay off their debt? And what about all the students next year that are going to take on debt? But you've just canceled all this other debt here. I don't understand how that's going to work out.
Yeah, so this is a great question, and I would like to zoom out a little bit and talk more policy, because people get very upset when you talk about these type of things, right? I had to pay my student loans off from law school, and now you're saying that my brother doesn't have to. That's
Right.
fundamentally unfair, right? And this really goes back to the conversation that took place when the Trump tax returns were leaked. And my response to that is, listen, the tax code is a series of incentives and disincentives to do certain things.
Mm-hmm.
And you should not fight the tax code. You should go with the flow. But ultimately, it's up to Congress to figure out, from a policy perspective, what they want to incentivize people to do. It is very clear in today's tax code, they want to incentivize you to own your own home, to get married, and to invest in commercial real estate.
For sure.
These are all
And have kids. Yeah.
And to invest in private equity, to invest in long-term venture capital, to have children. These are all incentives that we're pushing. And once you start introducing these other concepts, canceling student loan debt, what you're going to see are more people taking out student loans, right? I mean,
it's going to increase the cost of education exponentially.
Yeah. And that's also, we're going really far afield here, but it's a cool conversation. From a policy perspective, I think one of the biggest issues that we've experienced probably since Bush has been conceptually thinking that this attaining a college degree is somehow going to solve inequality issues in this country. And the reality is, getting a college degree is not a good indicator of your lifetime earning potential. It's a better indicator is what zip code you were born in. And so I think we need to rethink how we approach education in general in this country, because this false promise of having these people take out these massive loans to achieve this degree that ultimately does not serve them well long term is almost fraudulent, honestly, from a nationwide conversation.
My kids are 3 and 6, and we're putting a little money in a 529 plan, but I'm actually gonna teach them how to start a business. I don't want them to go to college. I want them to go to 2 years, so for the social perspective of it. But yeah, it is no longer the means to get a job, a high paying job. In fact, it's creating a workforce that is beholden to their employer forever. It's the new pension plan. But in this point, it's debt. It's
right.
Like teachers that are required to get master's degrees from these institutions. And so they come out of there with $100,000 in debt, and they earn 50 grand a year. Like, good luck. You're never going to be able to buy a house. You're always going to either get in the lease trap of a car. It's bananas. So yeah, I mean, we don't have to dwell too much on this, but
No, it's important though.
I'm just curious. Like I look at that as, you know, with anything, you know, much like being a Midwest guy raised in a conservative family, you know, I tend to lean a little, I'm center and maybe a little left on the political spectrum. Living in Portland, where it is almost as far left as you can get, it's concerning to me when you see governors taking on more powers over the people. And the one thing I know is true about all politicians, no matter how virtuous they are, they like power. And once they have it, they'll continue to use it. The Patriot Act is still a thing. You know, I mean, if that doesn't tell you any, like these things don't go away. And so I just worry, like economically, when you set a precedent, if they actually do, I'm not sure it'll actually get passed, but if they actually do cancel student debt, like what's next, you know, and who pays for it? So to me, it's a big existential problem.
Yeah, I mean, somebody's holding those bonds.
Right.
I mean, somebody needs to get paid, and there's a lot more that goes into it than just waving your wand and making it go away.
Right.
I agree.
So I wanted to talk to you a little bit about, I do agree about the kind of, to come back to office spaces outside of downtown city centers. That's been a trend that's been growing, and I think it will grow exponentially from here, because like one thing that I think culturally we've seen a shift is, you said that there's this 15-minute radius. I think that's the only thing I would disagree with, is I think the average commute time is much further than that. And so people are forced to go, you know, they want to live in the burbs where they're close to all their kids' activities and friends, but they just have to work downtown. And so I think you're going to see a demand. The problem is maybe not everyone that works in that place lives in that place too.
Right. I'm talking from it. That's a fair point. And I'm coming from a perspective of the decision makers who are entering into the lease.
For sure. Oh, I totally agree.
They need access to employees, and those, they need, you know, interstate access. But frankly, at the end of the day, they're going to move to where it's convenient for them. And so, and maybe there's exceptions there. Maybe if you're running like a call center or something, that might be different. But for the most part, for professional and financial services, it's going to be convenience factor for the decision makers as well as the clientele.
For sure. Yeah, and I see smaller offices, many more offices. So you look at a complex like a Merrill Lynch, might even divide up. You know, they have like 2 or 3 complexes in Cincinnati. They might have 10 smaller ones to kind of pepper the city, which is way more convenient for everybody. But so how does, you know, an investor, whether they're a client of an advisor or just an individual looking to invest in a space like that? I think a lot of people are confused, because I think most people, all of their money's in a 401k or an IRA. So I don't want to necessarily get into self-directed IRAs just yet. Let's just all talk about non-qualified taxable money. We can dive down that rabbit hole if we want to, but what's an approachable way to invest in commercial real estate as we've just talked about?
Yeah, it's a burgeoning area, and it's a great question. And I think one that needs to be talked about more, because if you are an accredited investor, so you're a high net worth individual, high income earner, for the most part, your accessibility into these product types are going to be REITs, which we talked about are not really, you know, a great fit there. Some kind of expensive fund to fund vehicle that your financial advisor, you know, through Carlyle or Blackstone, where the fees are going to be really high. They're going to be driven by non-taxable, huge investors for the most part. And you have no real relationship with the sponsor or the general partner at all.
It's like investing in a mutual fund of real estate.
Yeah. It's, you know, the fees are really tough on the front end. The gross IRRs are probably going to be pretty attractive, but at the end of the day, on an after-tax net of fees basis, I'm not sure it really makes sense to lock your money up for 10 years on that kind of thing.
Would that include private equity?
Yeah,
okay.
100%.
Yeah.
But what's cool that's happening now is the democratization of access to alternatives, where, you know, the accredited investor status, I think, is going to continue to be diluted, which is going to be one way that politicians kind of try to breach this inequality gap. I don't think it'll work, but I think they're going to try to do that. And you have the ability, if you have some time on your hands, through LinkedIn, podcasts like this, webinars, etc., you can educate yourself about how to invest in what are called, private placement offerings, where your Reg D offering, that's kind of what we are, and you can invest deal by deal with these different groups that are
Can
called
you give me an example?
sponsors. Yeah.
Like just make like, could you just make up like we live in Anytown, USA, a suburb of Anytown, USA, and there's like a 10-story office building that's going up.
Yeah. So how you would access that deal?
Yeah, from an investor standpoint.
Yeah, it's going to be hard because unfortunately there's just the marketplace is still so young that people
Mhm.
like me who, I'm called a sponsor, I'm a general partner. I find a deal, I run the deal, and then I raise capital on a deal by deal basis to a network of individuals and families.
That's what I mean. So explain.
Yeah,
So that's what you do. That's what
that's what I do. I go and I've been doing this for 10 years and I've
So you
got,
find this deal. And maybe it's too big that my example.
that's fine.
Let's say it's a strip mall. I'm just making something up, but like,
Yeah,
let's
the
say
way it
there's a
works.
deal. Yeah. Yeah. Just
Yeah.
the listeners understand.
So the way this works, I find a $10 million office building that I think is attractive. It has a nice yield to it. I like the location. I think there's some upside. I have a network of 5,000 individuals and families and boutique wealth management firms that I send the deal out to. So I have all of my legacy investors. They get a first look at it. They usually compromise 10 to 25% of the equity I'm trying to raise. And then I go out to a broad network of other groups that I've accumulated over the years. And we just kind of first come, first served. Who wants an allocation? How much do you want? They commit verbally. And the whole thing probably takes 100 days, right? So we go out with the.
So hang on a sec. So let's say I'm on your list, and let's say I'm not an advisor in this example, and I'm just a guy.
Yeah.
And let's say I've got $100,000 I want to invest. So I get your email, I read through and be like, wow, the IRR on theirs could be 8, 12%. That sounds awesome. Is there a lockup period usually? Is it
Yeah.
just for the term of the deal? And so I look at that. Is there an income potential? Is it a buy and hold? I'm assuming these are all terms of like, are you buying this to improve it and flip it? Or are you a long-term hold? Let's just generate the yield off of it in perpetuity. And so all those are attracted to me. So then what do? I just say I'm in, and let me know when you need the money.
Yeah. So if you're known to me, if you're a prior investor or a friend and family, you just say, hey, text, email me, call me, text me. I want $100,000. I pencil you in, and then we move on. The next step would be that you would sign the operating agreement to that asset, which is a document that pretty much lays out your responsibilities as an investor, my responsibilities as the general partner. You are a limited partner in a lot of senses, right? So you don't have a lot of rights other than the right to economic interest associated with how much you invest in that deal.
Right. You can't pick paint colors.
Right. So you are a limited partner in the, as a former attorney, I tell people all the time, limited is the key term here. You have some economic rights, but for the most part, you're along for the ride. And so
you can't drive by
passive
the building
investor.
and say I own that building. You say I invested in that building.
Yeah, that's right. So you're a passive investor. And so you sign that operating agreement. We would ask for funds probably 2 weeks out from closing to be sent to escrow. Your signature page and those funds are held in escrow until all third-party closing conditions are met. So diligence is complete. The lender has signed off on everything. The seller's counsel has signed off on everything. My counsel, as well as our internal deal team, have signed off on everything. Once all those conditions are met, the signature page is released, the funds are released, and we close. And then the entity that you invested in owns that building. Mm-hmm. And we can talk about the investor's journey from when we buy to when we sell if you want to.
Let's do that. Let's do a hypothetical on that. I think that's important.
Yeah. So, and there's a whole host of questions that I would ask during this process, but we can go through what the journey looks like. So typically you and I would connect at a conference or through a friend of a friend. We would go through that exact process that I talked about of you evaluate this one deal, you like it for whatever reason, you invest $100,000, we purchase it. that time from when you say, yes, I'm interested to when I purchase it, that's probably going to be somewhere on the lines of 3 months. It's usually about 100-day process, which is good. There's a reason for it to be slow, which we get into, but it is a long process. Once we buy it, and I am very vocal about this now, much more so than I was early in my career, but we set expectations very much on the front end. So what you could expect from me is access to a 24/7, 365 investor portal where you can see your commitment amount, you can have your ACH information uploaded, you can change your content information, you can see historical financials, you can see historical reporting, you'll get your K1 uploaded through that document, etc. So that's what you can expect from an access standpoint. We send out monthly P&Ls, financials on the asset level. We send out quarterly commentary on the building as well as the market that it's in. And then we send out monthly distributions. So a certain day of the month, we have everyone do ACH now just to avoid fraud and issues associated with mailing checks. So you'll get ACH at your account like the 15th of the month or whatever the date is. And if you email me or you call me, somebody on the team will respond to you within 24 hours. It won't always be me, but somebody will respond to you. We won't always have the answer to your question, but we will call you back. That's kind of the expectations. And I don't take business calls on the weekends for the most part, because that's my time to spend with my family. And I have 550 investors. And if I let everyone call me on a Saturday, my Saturday would no longer be mine. And I won't be a very productive manager during the week, which is what you want me to be.
Right. No, that's good.
So that's kind of what that journey looks like. We hold the properties long-term. You can expect cash flow. We do accelerated depreciation and cost segregation analysis. So ideally your K1 is going to show a loss while you're still getting that 8% cash on cash annualized yield, which is a really nice way to offset gains elsewhere in your portfolio as a taxable investor. So I have a controller in-house who's a CPA with a public accounting tax background. We're very tax oriented when it comes to organizing these things, and that's a big emphasis for us.
Have you gone through the scenario where you've unloaded a property through sale?
Yeah.
Can you walk for listeners' perspective? Can you walk through like, okay, so I've invested in this $10 million deal that you referred to. Now we're 8 years into it, and cap rates have continued to decline, and so you're like, oh my goodness, let's take the nut on this. How does that work?
Yeah. So the thought process we go through is, most of my investors would prefer to have the coupon than the money back because they don't have a productive place to put it. So it has to be a pretty attractive multiple on invested capital or IRR for us to divest. If we were able to sell for an attractive number, you would get all of your accrued dividends, obviously. And then we do a math equation basically where my deal with you is, I promise you an 8% preferred return annual. And then on the back end, once I give you your original committed capital amount plus that 8% preferred return for the hold period, after I've filled up those two buckets, the third bucket we split 80% pro rata to the investors based on how much equity they invest in the deal. 20% of the profit on the upside goes to me as the general partner.
Right.
And that's a pretty standard private equity type model of how we distribute profits and proceeds. But I don't take any of those profits until there's a realization sale event.
Thanks for tuning into the
During the whole period,
today.
I'm pushing out as much cash as I possibly can because
me,
I really want to hit
Cups.
that preferred return watermark to make my profit
a
as big
registered
as I
investment
possibly
advisor
can. So it's a good alignment of interest in our opinion.
None of the topics discussed
I agree.
today should be taken as advice. Please consult your legal or tax professionals if you have any questions.
Thanks
again for listening.
Are you working with many advisors? Are advisors starting to look at this as, let me back up. My hypothesis ever since 08 has been, the response to 08 was the death of bonds. And it really, the yield you're going to get in bonds is basically, we're riding the bond bull market from 1980 to now. I never thought bond rates could go to zero, but as rates decline, prices go up, and that's where you make extra yield. So that 60-40 model, you got an unintended and unexpected additional return from the 40% that was in bonds that you got over the last 40 years that you will not get going forward. you might get half at best. And so I'm looking at it as I want to start shifting, like if you're just in that, the quintessential 60-40 model, and of that 40%, I almost don't want any bond exposure. In a perfect world, I would want to figure out how to move the majority of that into real estate. Are you finding, well, simply just because of the yield, the yield is more attractive than stocks, but your beta or your volatility is significantly lower. Are you finding there's more and more advisors that are thinking that way? Are you working with a lot of advisors?
Yeah, it's a great question.
RIAs, because you probably can't work with people at Merrill.
Right. So to educate people listening, first off, the answer is yes, we do work with some advisors, and it is mostly because we're trying to solve for some kind of fixed income replacement vehicle. And a lot of people look to real estate for that, which makes a lot of sense. In terms of who we can work with and who we can't, if you work at a big, Merrill Lynch is a great example. If you work at a big wirehouse or New York firm, they cannot send you investors. That's called selling away. And that is a big no-no in FINRA land, and they'll get in trouble for that.
Right.
And so where we end up working with is this really growing space of kind of RIAs who are, fiduciaries, and they have either a multifamily office functionality, or they work with a number of high net worth individuals, and they will either create an internal fund that will participate in my offerings, or they'll pass the hat, or they often will have some kind of separately managed account relationship with a larger individual or family that they know they want exposure to these type of things. And so we do work, that space is growing tremendously, and a lot of them want access to alternatives because, frankly, the fee compression is no longer a value proposition in that space because fees have already been pretty truncated. Mm-hmm. And so concierge services and access to alternatives is one of the few ways they can differentiate themselves. But they have a big issue with finding decent sponsors. So, if they find somebody that they like, it can be a great relationship. Sure. I'd say probably 25 to 35% of our equity comes through those type of relationships. Otherwise, it's just direct.
Right. Well, and that's, that's kind of my, that's where I'm going, with my clients. We've already started that process for some of them. And, so just for the client's sake, an accredited investor is $1 million net worth, $300,000 or $300,000 of income if you're married, filing jointly for the last two out of the last 3 years. Is that right?
Yeah. So it's 300,000 if you're married, or I think they change it every year, but 200,000 if you're single.
Mm-hmm. And it's 2 out of the last 3 years.
Correct. 2 out of the last 3 years, or you could have $1 million of net worth minus your primary residence.
Right. Yep.
And those are the two kind of, and there's and something else that we don't have time to get into, but do be aware that if you're working with a sponsor that works with non-accredited investors, so a 506B offering, there's a big difference between that and a 506C offering in terms of the experience you're going to have, I think. And we only work with accredited investors. But that is something that you should look into because those are two different worlds for sure.
Oh, absolutely. Yeah. I was just curious on, because the fact that this space is called alternative is hilarious to me, because the American dream forever has always been about real estate. It's been own your own home. Now that's, in my opinion, that's not an investment because that's money you'll never see again. It's just nice to have a place that you can live for free when it's paid off, essentially. But it's dollars that it's never going to provide you any value other than a roof over your head. And then your kids get to sell the asset and use it, when they're old and, the world goes round. But the fact that it's still called an alternative is just rooted in the lack of opportunity that investors have today. You pull up, you just watch CNBC. How many real estate developers do they have on there? How many that aren't the giant ones that have, and it's always REITs. You know, it's how many small guys like you are on there talking about the value of investing in real estate? Never. You know, it's all about stocks, it's bonds, it's gold, it's stuff that you can put in your 401k. And I get it, it's an ecosystem, but to me, we got to think differently. One, if you call yourself a fiduciary and you are not thinking about it like this, you're not a fiduciary. You know, you're just playing the model. You know, I pick on Merrill because I used to work there. That's where I got started. But you have a list of things that you're allowed to invest in, and that list never includes real estate. It only includes what they approve you to invest in. And so if you can't make your ends meet in retirement because bonds don't perform, it's the advisor's job to give you an alternative. And that alternative shouldn't be an annuity. It should be something else. And so to me, there's a disconnect right now with what's being talked about in our industry as advisors and what's actually being practiced. And the term fiduciary, while it's nice, the fact that we have to identify that and differentiate based on that term is hilarious to me. You should always, we're in a service business. That's, if you don't do that, people are going to get wise and go somewhere else. So yeah, I've been scratching my head now for 12 years and trying to find access, you know, to deals as an advisor. And I started my firm 5 years ago. And so, it's been a slow journey too, to find the right custodian that will allow it. I've actually had to go off and create, self-directed IRAs, because most of the money I manage is tax qualified, and then we invest in it through that way. And for listeners, that's basically what he just said, is you can put these investments inside of an IRA. You can't go to a big firm. There's other little firms that I use that will allow you to facilitate this. But it's tricky, because if you don't get it right, you kind of get walloped with taxes.
Yeah.
So anyway, I'm on a soapbox right now, but that's why I was so interested in talking to you, is and why I asked that question of what are other advisors doing, and I've heard some independent advisors are starting to look at this. But, you know, do you think that this will become an extremely robust space in the next 10 years?
I do. I think, you know, the advent of access to alternatives and private equity is going to be kind of the talking piece moving forward, as, you know, the public markets seem to be, you know, manipulated. As we talked about earlier in the conversation, the number of publicly traded companies continues to go down in general. And to be frank, the market is no longer representative of the overall US economy.
Oh, okay.
And it hasn't been for a long time. So, and the amount of participants in the stock market continues to go down as well. The concentration of people that own stocks continues to dwindle. And that's because I think people are seeking out private offerings through their networks and through various platforms like LinkedIn, frankly. And so I think it's going to be a place where more and more people look, and especially this millennial generation that has an inherent distrust of some of the larger Wall Street names. I think the whole industry is skewing towards niche, boutique, smaller, and the wirehouses are going to continue to struggle in that space.
I don't think that's why participation rates are down. I think that has more to do with the wealth divide, and the fact that the average tenure at a company is 4 years now. And so people just don't start their 401k at the new company. You know, mandating 401k creation and funding by employers would fix that.
Yeah.
But
well, to your point about self-directed IRAs, I think the latest number I saw was something on the order of like $3 trillion of money in the SDI and the self-directed IRA space, and less than 3% is in alternatives.
What is it in?
Just, you know, the market.
Oh, using self-directed IRAs to So when I say self-directed IRA, like I'm not talking about my own IRA that I may have at Fidelity. You know, I think that actually may fall into that term. A self-directed IRA is just an IRA that an individual is managing them by themselves. They're not using institutions like us to manage it for them, right?
Well, and that's where, you know, different, to your point, different custodians have different thoughts about kind of that. So they're fiduciaries, so they can't direct you to a certain investment, and they can't direct you to a sponsor like me. But the more progressive, forward-thinking ones have platforms and marketplaces where if you, you know, had a liquidity event or you have enough exposure to the markets, you can say, "Hey, I want to invest in real estate. How do I do that?" And they can say, "Well, I can't advise you on this, but I can show you a buffet of options." And that's where someone like me, you know, who's on that marketplace, that's a place where we might connect.
Mm-hmm.
A lot of my high net worth individuals will hybrid it. They'll do, you know, $100,000 in a deal, and they do 50%, you know, individually on after tax dollars and 50% with their IRA, for instance. That's what a lot of folks do on a hybrid approach. But, you know, to your point, you lose some of the tax advantages of that when you do it through an IRA. But at the same time, you know, if you want to participate in these offerings, but you don't necessarily want to use cash to do it, it's a really nice way to gain diversity.
Yeah, like the majority of people that work their whole lives at Fortune 500 companies and were lucky enough, smart enough, and diligent enough to save to be able to retire, all their money's in an IRA. You know, I've met countless people in my career where it's 90% of their net worth is in one IRA, you know, it's if this one spouse stayed home. And they got to find the yield somewhere. So whether it stays in that ecosystem or not, but yeah, relying on bonds is, I think, a tough place to be if you are looking for that as the only asset class to generate yield. You either got to go real estate, but and so the tough thing is, though, I think we should talk about is, what do all the people do who aren't accredited?
Yeah, they have less optionality, but there are some crowdfunding websites that do a decent job, and it's a nice way to gain exposure to the space at lower minimums. So I always advise people that, you know, they might say, "Hey, I really like what you're doing, but I'm not accredited. How can I, you know, learn about the space in the interim?" And, you know, the crowdfunding sites, I think their deal flow can be highly variable. I think the fees can be very difficult to understand who's getting paid what when. But, you know, for $5,000 to $10,000, you can participate in a really big deal, and you can interview the general partner. You can get all the documentation, the reporting, and you can kind of, if you spread it around, you know, you do a deal every quarter, say, at the end of 2 or 3 years, you're going to have a pretty decent portfolio of diverse holdings. And, you know, honestly, that's probably one of the best ways to get access to the space these days. I really caution people against, you know, there's a reason people like me exist. There's a reason the ecosystem exists that it does. I get a lot of calls from people that say, "Well, I'm just going to do it directly. I'm going to do it myself. I'm going to buy a single family home and rent it out," which is fine. You'll learn a lot of lessons the hard way there. But, you know, if you have a day job, I always encourage people to consider just being a passive investor, because, you know, I've got 15 employees, and this is what we do all day, every day. And it's a lot of work. And, you know, to be able to access a deal without having to take on any debt or liability, there's a lot to be said for that if you're just learning about the space. So
yeah, your liability is no different than investing in stocks. You know, it's just it's a matter of return, and return of capital and return on capital. Yeah, I you know, I personally own a bunch of single family homes, and if you do it right, then you can do very well. But yeah, you're right. You're owning that debt, you know, and if those things go unrented or if something happens, the liability all falls on, well, I mean, if you do it right, you have an LLC that kind of insulates you a little bit, but I mean, the returns are attractive. It just is a matter of, you know, I look at if you live near your properties, if back to single family homes, then you might, and you're handy, you could manage it yourself and save the management fee. But if you want to really do a set it and forget it, finding a good property manager and just say, here's 20 grand, go buy me a house, rent it out, send me the gravy every month, is one way to do it as well. But no, and I just, having a diversified portfolio of real estate, you know, and I think the industry, my industry needs to kind of, I think, decouple that term. You know, real estate is not like stocks. You know, stocks are all correlated to one another, regardless of industry. I mean, long enough period of time, the correlation of every sector is about one. But with real estate, you know, that's why I kind of wanted to nuance it, because you've got a whole bunch of different options that all function differently. You know, it's you could do. What do you think of the medical office space?
Yeah, I mean, MOB, medical office buildings, you know, it is dominated by the REIT market. So cap rates are very tough. If it's, you know, Class A on campus MOB, it's going to trade at a huge premium. I like the medical arts space where you might have a building with a LASIK eye center, surgery center, some kind of in-house, like plastics, orthodontics, something that's not going to, and it might be a hybrid, right? So that might be on the bottom floor, then you have traditional office on the top floor.
Mm-hmm.
I really like that play a lot because you're getting exposure to some of that medical profession without having to pay the freight on a cap rate basis of a full-on medical office building. And typically they have huge amounts of tenant improvement infrastructure that they put into the building. So they're pretty sticky tenants, and they're not likely to leave typically. So,
but do you see that space nuancing much like our conversation with, let's say, like a Merrill Lynch, where they're going to be smaller in the future, where they're going to be more boutique? They're going to, because as the real estate market landscape changes, do you see them continuing to be dominated by REITs? You know, because I think one of the reasons that they are so big is because REITs are there. When you manage billions and billions of dollars, you can't go and buy 1,000 little strip malls. You got to go buy 4 big office buildings. It's way easier to manage. Do you think that dynamic is going to change a little bit?
I think the more concerning dynamic that I'm seeing play out across the spectrum is private equity accumulating the actual practices themselves. And, you know, it's very hard to find a well-run independent group anymore because private equity is bidding up all of these things.
Yeah, and screwing the doctors in the process.
Yeah, so, you know, that's a bigger concern to me because $1 billion private equity fund that wants to, you know, consolidate my dental practice that's in my building with another one and move locations, that's a decision that I have no control over and is a dynamic that I think you'll continue to see play out. So I'd be a little bit concerned. That's just become kind of hot private equity roll-up fodder across the board, every type of practice area. So that'd be a little bit more worrying to me than the REIT world.
Gotcha. Yeah, I see what you're saying. Yeah, it's a problem. I mean, yeah, the more and more I hear about, whether it's hospital groups or private equity, man, private practice doctors are getting screwed. And it's not great for the future of our healthcare system when it comes to that, because they're getting overworked and underpaid all day, every day to make the guys in New York money. So yeah, I would just, I would urge every private practice doctor listening, maybe rethink those deals. They might sound attractive on the front end, but you get it in the back end.
Yeah. I mean, it's difficult. But I can tell you from my own experience that we work with a lot of family offices. My wife has a single family office here. And if you talk to a first generation wealth creator that had a liquidity event, sold to private equity, if you talk to them probably 10, 15 years after that transaction, you get a couple of drinks in them and you ask them, what do you really think about that deal? Most of them would say, hey, you know, after the fees and after taxes,
It didn't work out the way they wanted it to.
The problem is they've got to maintain a quality of life, a cost of exponentially growing family base, and you've got to contend with inflation and your return profile. And typically when you do the math on that with your spend rate, operating expenses to maintain your quality of life, your bogey is like north of 10% average annualized. And that's just really hard to do without taking an enormous amount of risk. So oftentimes they would prefer to have just held on to the operating company long term, because it's really hard to find those returns in the private marketplace.
Right.
That's the real challenge, I think, is if you're looking towards a private equity exit, really understand what your 20, 50-year goal is, because private equity will slap a big multiple on there, but it just may not achieve your long-term goals, I guess.
Right. Right. Yeah. And I'm hearing more and more stories like that every day. People that, regret it as soon as 2 years after the deal. They're just like, oh no, what did I just do? When they're starting to get calls about, how much did you grow the practice this year? Here are your metrics. Here's your nut. You got to do it. Yeah, it just changes the dynamic of the relationship between doctors and patients too. Everyone suffers in those deals. So that's interesting to extrapolate that risk out across the medical office building space. I had not considered that.
And I do apologize. I've got a hard stop at 12:30. So.
Oh, you're good. Yeah, we can wrap it up.
No, we can go another 10 minutes. And this is fun. I just wanted to preface it.
No, I appreciate it. I like conversations like this.
No, we could do this for another hour probably.
Right. Yeah. Mine usually lasts an hour or two at least. I had a few that lasted a long time and then I never released them because they were just, the conversation wasn't about one thing. It was about everything. It was almost like a Joe Rogan podcast. I'm like, no one's going to listen to that. So, but anyway, no, it's been very, very helpful. And I think to our listeners too, just to know that, there is a movement that's happening, especially in my industry, of people who are looking at alternatives. The problem is it just takes a long time. You said it best, like after 2 or 3 or 4 years of investing in something quarterly, whether it's accredited or not, it takes 2 or 3 or 4 years to build up a portfolio that's functional, that actually provides the value, where with stocks and bonds, it's immediate. It's just, there's a system there, an ecosystem, especially with ETFs. It allows for immediate yield, immediate dividend returns, and immediate gain or loss. And real estate doesn't work like that. Thank God it doesn't work like that. But
thank God it doesn't work that. And that's where I was going to go is, if it was a liquid, if I was a liquid investment and if my portfolio was a REIT, every one of my investors would have sold out in March and April and gotten their head caved in.
Yep.
And the nice thing about what we do is there's no scoreboard every day. And I tell a lot of my investors, listen, you can read the quarterly reports, you can look at the monthly financials, and you should. I encourage you to do that. You shouldn't really judge the investment more than probably once a year, to be honest with you.
Well, do you know that's how often mutual funds were priced when they were first made?
Is that right?
So they were invented in 1933, and they would price them once a year.
That sounds reasonable.
It's not in the day
today, but
but that it's like in 2008 when the housing crisis happened. Did people go out and sell their houses unless they had to because they lost a job? Did like us, maybe me, I didn't sell my house. It lost a ton of value. It was down 40% from, a year prior. But I just didn't think about it because I didn't actually see the value. I don't even think Zillow was around then. But now you can see the value and it fluctuates here and there. And I think Zillow is actually going to, be a detriment to the residential real estate market because of that. But yeah, I agree. I think having it be illiquid and a long-term approach and not looking at it daily is just better for everybody.
But, if you are interested and you're a listener, the cool thing about what's been happening the last 6 months is people like me, because we can't network, I can't go to conferences, I can't do the meetings I used to. What I've been doing is creating a lot of content in order to just help people, to be a resource for people, to be considered a thought leader in the space, and hopefully engender more investor networking. And the upside for you, the listener, is go on my website, click the resources tab. You could spend a day going through the blog pieces, the webinars, the podcasts, and you can learn if you put the time in for free. Not your time is valuable, but for no money outlay, you could become an expert investing in office, within a month if you wanted to. Same for multifamily, the usual food groups that we talk about. So the nice thing is there's a whole universe of options, and it is a very inefficient, unregulated space, and you've got to be careful. The upside is now with everything happening on the media space, you can learn really quickly and you can network really quickly. You can reach out to me if you live in Portland, shoot me a note on LinkedIn. I'll have a call with you. I mean, that's what's been cool about what's been happening now. And I think you'll just see the ecosystem become much more sophisticated over time, but it still is a little bit of the Wild West. So you have to be careful, but you can educate yourself really quickly.
Yeah, that's great. That's great. Well, I appreciate the time today. How can people find you?
Yeah, thank you for having me. This has been a lot of fun.
Absolutely.
Yeah, I'm very active on LinkedIn. So if you look at Brian C. Adams, Excelsior Capital, connect with me, shoot me a note. I'd be happy to help any way that I can. You'll probably get your money's worth for my free advice, but I'm happy to give it. And then if you go on the website, excelsiorgp.com, we do have a big resources tab. I would encourage people, if they're interested in learning about depreciation, cost segregation, any number of things that we talk about, it's all right there for you. And I would encourage you to sign up. We do have a newsletter. If you're interested, you can sign up for that. But yeah, thank you for having me. It's been a lot of fun.
Absolutely, man. I appreciate it. And yeah, let's connect real soon.
Sounds good. Thank you.
All right. See you.